The Hayes Advantage with Kathleen Hayes.
My guest is David Edwards. He's president of Heron Financial Group. We've got a lot to talk about with Dave today, but one of the things he's really fired up to talk about is the cost of the destruction of trust. David, welcome.
Good afternoon, Kathleen.
Now, first of all, let's lay out who you are, where you've worked, all the things you've done, because you have not occupied Wall Street, but you have worked on Wall Street for a long time.
Yes, I have. I'm the president of Heron Financial Group, 20 years now. Before that, Morgan Stanley, JP Morgan, and Nomura Securities. First started working on Wall Street in 1980.
So he started as a child, actually, despite a little child labor. But still, just to make, I want people to know that you've worked on Wall Street. You've made your living successfully on Wall Street.
For the last 20 years, I've taken care of the financial future of about 110 families who are trusting me to make good decisions on their behalf and for their children and for their grandchildren. And so much has happened in the last 4 years that has destroyed trust. Even people like me who work very hard to be honest with our clients have to redouble our efforts to show why we are trustworthy.
So let's talk about this. What has happened? Where do you see this destruction of trust?
Well, the history of the last 30 years has been interesting in many ways. But one of the most interesting things to me is that, back in 1980, 83, when I first went to work on Wall Street, lawyers, bankers, and doctors all made about the same pay, which stands to reason. They had the same background, the same education, and bankers were very conscious and very aware of making good decisions. I started out initially at JP Morgan, and boy, they were very serious about making good decisions. Somewhere over the last 30 years, that went off the rail, and I think it's because, in 2008, lawyers made twice what doctors made, and bankers made 10 times what doctors made. And their judgment and their ability to make good decisions was skewed by the fact that they were getting paid so much money. They were getting paid a lot. They thought they were smart. But they also began cutting corners. One of the unknown, or one of the sort of lesser-known secrets of Wall Street is that finance is essentially a commodity product, like the oil in your car. You need 5 quarts of it to keep your motor running, but it's a commodity, and it deserves to be priced as a commodity. Well, if you're Bank of America or Goldman Sachs or Morgan Stanley, and all of a sudden you have thin margins and commodity pricing, all of a sudden you can't afford to pay out the somewhat extreme compensation. So then you start cutting corners and creating securities that are, in fact, bad for your clients, or you put out derivatives that nobody understands. And when you have trust of your clients, right, there were plenty of mom-and-pop pension plans out there who bought Goldman Sachs bonds in the 2000-2007 time frame. You can get away with that. But post-2008, we've learned how garbagey those securities were, and now that trust is lost and hard to come back. And because of that, you see enormous pressure right now on banking revenues and therefore on margins and earnings.
Well, it seems that if I was a banker, I guess what I would say is, well, David, but look at all these new products we created. We've innovated. We've gone global. That's why we make so much more money.
And I'm totally cool with financial innovation. I think mortgage-backed securities are an awesome product. I worked in them at Morgan Stanley back in the early 1980s when they were brand new. I worked in CMOs when they were brand new. I worked on swaps when they were brand new. But at the end of the day, you have to be able to look into the mirror and ask yourself, did I sell my client a high-quality product? And the mortgages started out being fairly high quality, became low quality in the subprime era, and now are toxic, and now nobody wants to touch them.
Well, in fact, that's one of the problems right now, right? The securitization market is broken, et cetera, and that's one of the reasons why the mortgage market isn't functioning better.
Absolutely. So you might say, well, Dave, isn't caveat emptor, buyer beware?
Yes. Thank you, Dave.
The operating mode for our society. And you go, well, think about the car industry. The car industry lost the trust of average Americans in the 1970s when they began building shoddy and dangerous cars. It took them over a generation to earn that trust back. But meanwhile, they lost a lot of market share.
Goldman Sachs. The securities, the portfolios it put together, securities it's structured for John Paulson, who made so much money betting against subprime products in the crisis. Many people have said, oh, but come on, the people who bought that stuff know full well how derivatives work. It's a zero-sum game. You win, I lose. They made a bet against John Paulson. So how can anybody come crying now that Goldman Sachs wasn't doing its job and fulfilling its fiduciary responsibility?
John Paulson was celebrated for having the greatest trade of the century. back in 2008, 2009, made something like $15 million for his clients, $5 billion personally, betting against mortgages. Well, how was that trade accomplished? Well, he went to Goldman Sachs and said, can you create a security for me that's guaranteed to fail? And Goldman Sachs, being good investment bankers, created that security and sold it to mom and pop pension plans all over the country. Paulson was their prime client. These little pension plans were not their prime client. They didn't mind burning them. I'm sure I'm going to get angry phone calls from Goldman Sachs friends after this interview. But as a result, there was not a creation of $15 billion of value for Paulson. There was a transfer of $15 billion from plumbers, teachers, firemen, you and me personally, to the Paulson hedge fund as a result of that transaction. It was not a value creation trade, value transfer.
Let's also get a very basic distinction on the table. You're an investment advisor.
Correct.
Contrast that to Wall Street, both in terms of what you do and how you're regulated.
Sure. There's two sides to Wall Street. There's the investment advisor, hedge fund, and private partnership community, generally regulated by the Securities and Exchange Commission. There's also the broker-dealer industry, that would be the Morgan Stanleys and Merrill Lynch's of the world, that are regulated primarily by FINRA. FINRA ultimately has to report to the SEC, but is the self-regulatory organization of the broker-dealer community.
Okay. So let's continue this, though, because what you do then when you advise a client, as you explained to me, is somewhat different. How you make the decision about what you're going to advise a client to do wouldn't necessarily be, but may be different from what an investment advisor on Wall Street does at a brokerage firm.
Correct. It is not apparent to the average investor that there are two standards on Wall Street. There is the suitability standard that FINRA-regulated broker-dealers adhere to, which says that if I have 3 investments and they're all suitable for a client, let's say they're different classes of the same mutual fund, it is okay for me to recommend the mutual fund class that offers the highest commission to me, the broker. An investment advisor ultimately harkens back to the 1934 Act, and is obliged to operate at what's called the fiduciary standard. What is the best possible solution for the client? So if I'm in the same position of offering the same 3 classes of mutual fund, I must offer the no load, no transaction fee product.
Well, what if someone says, well, but it may be that I get the best commission off a certain product, but I also see it as the one that has the greatest potential for appreciation. Mm-hmm. It may have a little more risk, but it may pay off better.
Right. But in fact, if it's the same mutual fund, the A share where the load is up front, the B share where the load is at the end, the C share where the load is over 5 years, or the advisor class, which has no load at all, in fact, it's going to have the same return, except that if you paid 5% up front, you'll never catch up.
Okay, so I'm sure there are many also would say, well, so learn about investments, you should look at what you're being advised to buy. It's just the way the world works. You got to educate yourself.
Sure. And I always harken back to that famous rant of Rick Santelli on the floor of the Mercantile Exchange a couple years ago. Why should I pay for someone's mortgage? They should have read the small print. Mm-hmm. And the bottom line is that neither you nor I nor most people ever read the small print. We trust the person recommending the product to have read the small print for us. That is the economic value of trust. It saves time. Okay?
So in other words, yeah, good point. So if I trust the bank to give me the best possible mortgage, or if I trust the bank to turn me down for a mortgage I can't afford, that leads to a more efficient system.
Absolutely.
And what about the cost of the destruction of trust? What happens then? What is the cost?
Well, if you think about what happened when the banks stopped doing their job and giving mortgages only to people who could afford them, a lot more money flowed into the real estate market. That created a bubble. Real estate prices, I think, rose, 2.5 times from 1990 to 2008? Okay? But was that value creation ever real or just ephemeral based on credit? Well, now we know. Once the credit went away, the prices collapsed 30 or 40%. Well, who cares, right? Well, if you put your life savings down 20% on a house and now you're 20% underwater, you care because you have been wiped out. So as a society, at a certain point, you have to ask the question, Are we willing to let tens of millions of American families be chum for financial service providers? And my take is no. That's when societies fail, which is why I'm a big fan of this new Consumer Financial Protection Agency.
You are, because?
Absolutely. Right now the playing field is uneven. You've got sophisticated creators of credit card products and mortgage products on one side that generate tens of thousands of transactions per day. You have individual families on the other side who do this a couple of times in their entire lifetimes. They don't have the education or experience to know what they're looking at. Somebody else has to look out for them.
I want to harken back to this. You brought up the point about Goldman Sachs structuring products for John Paulson so he could short basically subprime mortgages. Mm-hmm. They were sold to pension funds who represent regular people. So you
Absolutely.
say that was a wealth transfer from
Correct.
those people to the likes of John Paulson. And Joan Lappin from Gramercy Capital Management writes to me during the show, nice to hear from you, saying what Bear Stearns did, and they offered the same kind of thing, that they wouldn't do the Abacus deal because it didn't pass the smell test. She says Goldman didn't care. We've since learned that the trade wasn't Paulson's idea, but someone who worked for him who has since left. Paulson's down by half this year. His poor performance is awful. This hurt his name. But at the same time, he suckered in all the people who chased last year's winner as an investing strategy.
Isn't that interesting? When he had the opportunity to create these interesting securities and push them out the door, he made an awful lot of money. That game is now over. He has to do some homework, and it turns out he's not that good at it.
So do we need new laws or something? What are you trying to say we need here?
What's interesting right now is we had that Dodd-Frank bill go through, 2 years ago at this point, and it was pretty much a blank check. And so now there's a huge game going on in Wall Street to figure out what will be the actual regulations that run the economy as a result. What worries me an awful lot is that are we running out of time here?
We are. Just a tease. Something worries you. What is it? And then we can continue.
The laws will be diluted away. The history of high-frequency trading, I don't want to get into it too technically, but at this point, it's between 60 and 80% of the daily volume on the major exchanges. And that's why we have 5 billion shares traded daily. Well, what's exactly happening there? We're taking the same $5 bill, passing it back and forth between you and me 1,000 times a second. What's the value creation of that? There is no value creation between the two of us, but we're taking a little slice out of a retail trade or a mutual fund transaction and, again, transferring wealth from average Americans to a few Americans.
Well, the defenders would say it creates lots of liquidity and makes the markets more efficient.
And I would totally agree if it was 20% of the daily volume. But at 80% of the daily volume, what can that possibly be but a scalping mechanism?
Well, there you go. I think you're expressing a lot of. So what's going on? Let's look at regulation. Let's look at Washington, because some people would say, hey, look, there's plenty of regulation there already, and there has been, in fact, all along. But regulation hasn't been enforced.
There was some remarkable regulations that went into place in the United States in the late 1930s, Glass-Steagall and the Investment Advisors Act, many others that kept the financial service reasonably in check through about the middle 1990s. And then starting with the Clinton administration and then accelerating with the Bush administration, all of those safeguards and checks were systematically removed. Glass-Steagall went away, capital requirements went away, and then people were shocked when they totally face-planted in 2008, 2009. Dodd-Frank is trying to replace 60 to 70 years of discarded regulations in one fell swoop. But it's kind of a blank check. It says we need regulation, and then it relies on agencies and legislators to come up with actual tangible tools to actually make this happen. The piece of legislation that involves firms like mine personally is called the Investment Advisors Act of 2011. It's sponsored by Baucus of Alabama, a Republican senator. And the gist of that legislation is to take the regulation of investment advisors, hedge funds, and private partnerships from the SEC and move it under the purview of FINRA. And we who in the investment advisor community are opposed to that. We adhere to the fiduciary standard. We do not want to be dumbed down to the suitability standard that prevails for FINRA. Now you might ask, well, why is FINRA killing themselves to make this happen? Assets held by broker-dealer firms for retail investors have pretty much been static since 2000, unchanged. Assets held by investment advisors have doubled since 2000. Why? Because every week another $1 billion from Morgan Stanley or Merrill Lynch or Bankers Trust jumps over the fence and becomes an investment advisor. And FINRA makes their fees off of assets under management. They would love to pull all those assets back under their umbrella.
Well, isn't that interesting? And Max Baucus wants to help them do that.
That is correct. But you might say, well, wouldn't that be just fine? Well, in 2010, FINRA applied $43 million of penalties against their member firms. The SEC applied $1 billion of penalties against firms that it regulates. And that should be eye-opening.
Well, of course, FINRA is the Financial Industry Regulatory Authority. It's a self-regulatory agency for stockbrokers, and certainly there's lots of complaints that an injured investor, cannot get what compensated, do not get their due, right?
Mm-hmm. When you open a brokerage account, you sign an agreement that says that any dispute you have with your broker is going to be dealt with through arbitration, not through a lawsuit. That is the only industry in America that has that out.
Wow. So this is interesting because the SEC has already been criticized for not necessarily being tough enough, right? And so now there's a move to even soften what the SEC can do if you take the investment advisors and put them under the purview of FINRA, is what you would say.
Yeah. I would say that the Bush administration did to the SEC what the Bush administration did to FEMA, starved it of resources and put an incompetent in charge. I'm happy to say that the SEC is much more on the ball these last 2 years. They've got quite a few initiatives going on to find fraud before it occurs as opposed to after. I think it's important to note that while the SEC had some responsibility for Bernie Madoff's firm, FINRA had primary responsibility for Bernie Madoff's firm. No one seems to remember that.
Mm-hmm. And I think one thing that's always bothered me, it doesn't just puzzle me, it bothers me that the SEC could be even tougher in the sense of having more resources, having more people working for it, because the SEC returns money to the Treasury every year. Without increasing the burden on taxpayers, we could be more protected as investors.
That is absolutely correct. There's two easy ways to increase funding in the SEC. One is to apply user fees to firms like mine. Fine, we would pay that. Two, hey, give the SEC half of the fines that it obtains from the people it's regulating. That would be $500 million last year. That would almost double the budget of the SEC.
And not only that, another thing I've thought of is if you want to keep the smart lawyers and, in fact, the smart people who've worked on Wall Street and know how these sophisticated products work, Harry Markopolos, the original Madoff whistleblower makes this point over and over and over. You don't need lawyers so much now, he says, as you need people who understand these new products. Well, if you would let them, the SEC, pay them more,
correct,
you could compete. You could keep those people there at the SEC.
Right now, there are tens of thousands of Wall Street operations people who have lost their jobs. I think Morgan Stanley laid off 500 the last couple of days. They know how the sausage is made. Put them in charge of the sausage makers.
And why doesn't that happen? What is your suspicion here? What's going on between Wall Street and Washington?
Well, and this Baucus bill is kind of inching its way forward. It's been postponed several times. Right now, it'll take consideration in the spring. Even then, it has to go through the Senate, which seems to have no interest in it right now. So it may just die in committee. If that happens, then we have to come back and, at the legislative level, actually take steps to give the SEC the resources it needs. And let me just say that average Americans have the right to go on the Congress website and send an email or a phone call to their congressman saying, I would like the SEC to be funded properly, and I would like it to regulate firms properly so that I can sleep at night. Some
suspect that because a lot of people in Congress and in various White Houses get lots of contributions from the financial services industry, that is why the giving the SEC more teeth has not occurred from Republicans or Democrats.
That's absolutely correct. The financial services industry, banking, and real estate send 20% of all contributions to Congress and the White House. In 2008, the Obama campaign received $42 million from Wall Street-connected firms. Already, they've received about $16 million, about 20% of their total. It's going to be a phenomenal windfall of Wall Street money going that way, $140 million just to Congress, to incumbent congressmen and senators. And the money, by the way, is divided 50-50 between Democrats and Republicans.
Well, that's great about Wall Street, bipartisan. So why are you bullish on stocks in the midst of all this, Dave?
My forecast for 2011 was 8% in the S&P 500. And by April 29th, I was sitting pretty up 9%. Then the Japanese earthquake intervened, the debt downgrade, the European crisis. And so here we are staggering across the finish line. Tomorrow is the last trading day of the year, probably up 2 to 3%. Fine. But meanwhile, S&P 500 earnings are at a record level. How is that possible with the U.S. economy still struggling? The S&P 500 gets 60% of its earnings from the world economy, not just the U.S. economy. So that's we're taking advantage of India, China, South America, anywhere else you could. Africa, for gosh sakes, is making a play. Number one. Number two, valuations are at extremely low levels. One of the parameters I look at a lot is called the PEG ratio, the current PE divided by the forward growth rate. A third of my stocks are lit up right now with PEG ratios more than 1. In 2008, probably 1 in 10 or 1 in 15. And then lastly, we have an extremely low interest rate environment, 2% on the 10-year Treasury, which is going to prevail through at least 2014, according to the Federal Reserve. And you add those three parameters together and you go, wow, stocks are probably at the best valuations of the last 50 years. Will average Americans take advantage of that? No, because they're too afraid to step up. They don't trust me. They don't trust their broker. They don't trust any advisors. They'll sit on their hands and keep it in cash until the market doubles, and then they'll jump back in.
Cost of destruction of trust.
Absolutely.
But we could do something by writing our congressmen and
Absolutely.
women. Okay. Well, David Edwards, thank you so very much. You gave us a lot to think about today, as always.
Pleasure.
Thank you so much. President of Heron Financial Group.
Listen to the Hayes Advantage weekdays at noon Eastern on Bloomberg 1130 in New York or on Sirius and XM Satellite Radio Channel 113. Copyright 2011 Bloomberg LP.